Silver is the fuse. The spot contracts are just a way of managing the visible price, but they don't suppress the true value of silver, which is somewhere around 1,800 bucks an ounce. So at like 74 or 75, bargain, bargain, bargain.
How explosive upside could we really see in silver? And could it outperform gold in a big way?
With gold, I would say the same thing though, because where silver's the fuse, gold is the anchor. But I found 33 different entities that actually, on a global basis, that use physical gold in their work. Both the spot gold and spot silver went to not just extreme levels. This stuff is sloshing around and trading in the markets. It has absolutely nothing to do with real valuations.
If inflation remains sticky while growth weakness, are we entering the stagflation scenario you warned about? Where is the gold bull market today?
Well, the gold bull market is firmly intact, as is the silver bull market. But, you talked about that massive run-up in both spot gold and spot silver, because those are contracts. So I always have to go there because people are so used to just thinking that those spot contracts are the true value of gold and silver, and they're not. They're just contracts. But having said that, the last time I checked, the 200-day moving average, so let me kind of back up because this will explain it. So every day for the last 200 days, you total up where spot gold contract or the spot silver contract closes, you divide it by 200, and you have an average. That average kind of works like a rudder on a water ski boat. And if the spot price is a water skier, there's only so far above or below that average that it will go before coming back to central. Well, with all of the new money that's been pushed into the system, what's happening in your price action, and I don't really care what you're looking at, is that it is the flow of funds that is dictating the visible price that we see on those contracts. And so both the spot gold and spot silver went to not just extreme levels, but extremely extreme levels where, don't hold me to this because obviously I don't have it right in front of me, but I'm pretty sure that the spot silver contract, now 10% above, we're away from that 200-day moving average, is considered a lot.
Markets are celebrating higher gold prices while ignoring what those prices are actually measuring. Lynette Zang notes that silver moved far beyond levels normally considered stretched versus its 200-day trend, a signal that liquidity, not necessarily fundamentals, is dominating price discovery. The overlooked detail is that futures contracts can absorb enormous flows without reflecting immediate physical scarcity. For investors, the risk is confusing paper momentum with underlying value creation. Next, Lynette Zang reveals why a technical pullback may actually strengthen the long-term bull case.
So typically when you see that, you anticipate a reversal back to that. But I think on spot silver, it got up to maybe 80% above the 200-day moving average. And when I checked it last week, I don't know where it is right at the moment, but when I checked it last week, we were still 18% above the 200-day moving average, which means that it is still technically overbought, not overvalued. That is a completely different story. Yeah. But as far as overbought is concerned, if 10% is a lot, 18% is almost twice as much. So this is a normal consolidation that's happening in the foundation of this trend. The spot gold contract, I think, was 5 or 6% above that 200-day moving average. That's a sweet spot. So understand that it was just all the sloshing around. It's the same thing that's happening right now, where in the U.S. every day the stock markets are making new highs. It's because of how much of this stuff is sloshing around and trading in the markets. It has absolutely nothing to do with real valuations, this is just a big trading market. But gold and silver, that trend on the spot contracts is firmly in place. And I anticipate and expect a ratcheting up of those prices. Well, yet again, right now it's a Teflon market. Nothing matters. It's just going up. But it's because of how much new money has been pushed into the system, really starting in 2008.
Yeah. I'm glad you said it's a normal consolidation here. So, Lynette, at these price levels, what matters more, absolute price or physical availability?
That's a great question. And I would say absolutely that it's physical availability.
This exact setup has appeared before major advances, but only after investors endured frustrating consolidations first. According to Lynette Zang, silver remained dramatically above its long-term average, even after correcting, suggesting excess enthusiasm is being worked off rather than destroyed. The timing matters because liquidity-driven markets often reset sentiment before resuming their primary trend. Investors focused only on daily price action may miss what longer cycle positioning is quietly signaling. Next, Lynette Zang exposes why physical availability could soon matter more than headline prices.
And what we're seeing at the COMEX, even inside of these volatile prices, that there are entities that are definitely standing for delivery of the physical, which is quite unique in the U.S., but it is a testament to the trend, the shift in the trend that started a year ago in January, so we're almost a year and a half into it, where valuations are beginning to matter again. And I know it doesn't look like it in the stock market yet, but it will. But valuations are starting to matter again, and supply and demand is actually starting to matter again. And so we are in a transition where those spot contracts, of which they can create as many as they want to, there are no limitations on that, and make it look like there's so much more gold and so much more silver that's out there. But we are transitioning into that supply and demand market where that exactly what you just said, the availability, your ability to get it, is coming into question. And that's about to I can't say that's going to be tomorrow because these trends take a while to convert, but we are getting to a place where supply and demand will actually dictate the visible price that we see instead of all these paper contracts.
Yes, if gold is signaling systematic stress, what exactly is the market pricing in right now? Is it the inflation, sovereign distrust, war risks, not generally war, or monetary transition? If you can pinpoint one of them.
Well, I think it's really more of a combination. You know, because we're in melt up, the stock market doesn't seem to care about anything that's real.
A market can look well supplied on paper, while physical inventories tell a completely different story. What Lynette Zang is highlighting is that more participants appear willing to stand for delivery instead of simply rolling contracts forward, a subtle shift institutions watch closely. That creates tension between unlimited paper supply and finite physical metal. For wealth preservation, availability becomes the metric that matters when confidence in pricing mechanisms starts weakening. Next, Lynette Zang reveals what gold may actually be pricing in beneath the surface noise.
Right? It's just pushing higher because of all of that new capital that keeps getting pumped into it. But I would say, if you were just asking my opinion, which is the most important on there, I would say inflation. And the reason why I would say inflation is because this is a Ponzi scheme. We are all working for what are called notes, right? Wherever you are in the world. In the US, we're more obvious because we say Federal Reserve note. The Federal Reserve is a private corporation. A note is a debt instrument. So we are working for corporate debt, and we lost a lot of, well, the whole pattern shifted in 2022 when they broke that 40-year downward sloping trend cycle on interest rates and then had to start pushing interest rates up to attempt to tamp down, not stop the inflation, but tamp down the speed of it, because this is a con game. There is no value in this stuff. And so it requires public confidence. And recently we saw consumer confidence hit the lowest levels that they ever have. And they started tracking that in 1952, and it was lower than it's ever been. That's not good for a system that requires confidence and trust.
Yes.
The Fed says inflation is moderating, yet purchasing power continues eroding faster than many household budgets can adapt. Lynette Zang's argument suggests that inflation is not just a pricing problem, but a confidence problem, and confidence is the foundation every fiat system depends on. The contradiction appears when policymakers celebrate progress while consumers report persistent financial strain. For savers, that gap between official data and lived reality is where long-term risks emerge.
We didn't touch much on silver. I want to hear your take. How explosive upside could we really see in silver? And could it outperform gold in a big way?
Well, that's a great question, because for me, and when you look at the technicals, silver is the fuse. So silver, straddles it is the secondary monetary metal as well as industry. And so it has a tendency to be like, silver to me is the canary in the coal mine. And when silver is volatile and extreme like we see it, it's giving us a warning signal about the breakdown of the monetary system. So it isn't how high will silver go or how high will gold go in terms of this crap, right? Because it doesn't really matter. But silver is the fuse. And when you see silver behaving like it is, the spot contracts are just a way of managing the visible price, but they don't suppress the true value of silver, which is somewhere around $1,500-$1,800 an ounce. So at like 74 or 75, bargain. With gold,
Yeah.
I would say the same thing though, because where silver's the fuse, gold is the anchor. We were taught and trained to put value in this stuff because it benefits those that are in charge. But the reality is that this is what everything is judged against, is gold, not dollars or whatever you want to call them, the fiat money. And so the ultimate revaluation is when we get enough of these zeros on the currencies to go out and buy a stick of gum. The public does not trust the currency anymore. Therefore, the governments and the central banks have lost control. But at the end of the day, when they do that in an attempt to regain that control, then what they simply do is they take this that's all intrinsic value because it's used in 33 different places, and they revalue this that has zero intrinsic value, costs virtually nothing to create and can be created at will. And they do this overnight revaluation, right?
Markets went up, but confidence in fiat systems quietly deteriorated, and that divergence rarely ends well. Lynette Zang notes that silver's dual role as both an industrial and monetary asset makes it one of the earliest indicators of deeper financial stress. What institutions rarely discuss is that rising silver volatility often signals growing distrust beneath the surface of official stability narratives. For investors, the danger isn't price swings. It's being positioned for a world where monetary credibility breaks faster than expected. Next, Lynette Zang points out the specific positioning tactic in COMEX reporting that hides true institutional demand.
Yeah, Lynette, final question. Is there any bullish case scenario for you for the current financial system surviving another decade largely intact? Or is
No.
it totally impossible?
Absolutely, 100%, not one teeny weeny, itty bitty teeny, because the only tool that these guys have is this. That's the only tool that they have. That's it. And what happens when you do that? It costs nothing. But there is also a movement afoot where more people are waking up and they're realizing the system doesn't work for me. And this is what gives me a lot of hope, especially in the younger generation. You know, I held silver as my money. I remember that. But anybody that was born somewhere in the vicinity of 1965 in the US, they never had silver as their money. I mean, it was in circulation for a while, but they don't remember it. So we hand out these dime cards where we've got a silver dime on one side and a new dime on the other side. The day that we happen to buy this particular dime, and this is according to the spot market, it cost us $6.72. That was February 27th. Okay. This dime, what can you buy with that? Nothing. It's 10 cents. I don't even bother to pick it up if I see it on the ground. But this, I could still buy a cup of coffee. I can still buy an inexpensive meal, right?
Yeah.
So we've got to help educate people so that they can make those educated choices that actually puts their best interest first. Because otherwise, you're following people that do not have your best interest at heart. They have their best interest at heart. And they're at a level where, I mean, we just had an election go through in a midterm, which is not that big of a deal of an election typically.
If this trend continues for another decade, savers may discover their biggest risk wasn't volatility, but misplaced trust. According to Lynette Zang, the system's primary solution remains currency creation. Yet the purchasing power comparison between a silver dime and a modern dime exposes a reality few financial advisors discuss. The real contradiction is that people are taught to save in assets that steadily lose value over time. Investors ignoring monetary history could pay the highest price. Next, Lynette Zang reveals why public awareness itself may become a threat to the existing system.
It's not like the main one. And one of the guys had a war chest of $120 million to spend on that election. Now, who do you think is getting the ear of that politician? We have to fix this system. And the only way to do it is if we all come together. Because it's the 1% that's ruling the 99%. And I task every single person that's watching this or listening to this to look in the mirror and to ask themselves, if not me, who? And if not now, when? I say it's every single person that's watching this. And now, what are you waiting for? This, and I just got chills, but this is our opportunity. And I know that energetically, if we get 3% of the population rowing in the same direction and demanding the physical gold into the system again, I don't know if I can really do it, but I know if I don't at least try, nothing happens. And it's also in the evolution and the approach of it.
If inflation remains sticky while growth weakness, are we entering the stagflation scenario you warned about, I believe, in our last talk?
Oh, 100%. We are there. But, stagflation doesn't really sound that bad. That's when prices rising, but wages are stagnant or even reversing down a bit. And that's certainly what we've been seeing. If it was just a stagflation, okay, maybe we can deal with that. But this is the end of a currency's life cycle. This is the end of this great experiment. And I got news for you. It's going to last. It's going to be just the way this experiment ended.
Major financial shifts rarely begin when a majority agrees. They begin when a small minority recognizes the pattern early. What Lynette Zang is highlighting is the historical reality that meaningful change often starts with a surprisingly small percentage of the population questioning established systems. The timing matters because confidence-driven structures can appear stable until participation starts eroding at the margins. For investors, understanding sentiment shifts may prove just as important as tracking prices. Next, Lynette Zang unravels why currency experiments throughout history tend to end in remarkably similar ways.
This is my $10 trillion Zimbabwe note. So I'm a trillionaire in Zimbabwe, but I can't even buy an egg with it. This is the way it always ends. And then you go back to commodity money, physical gold and physical silver. And I want your viewers and your listeners to think about this because we are in the fight of our lives. We're transitioning into a brand new financial system, right? This stuff is used in one place. Even this is my physical representation of a Bitcoin. Cryptocurrencies, which are always gold, silver, and platinum, so you think they're real, but they're not. But this is used in one place. I recently did a count, so I'm not going to say this is an exhaustive list, but I found 33 different entities that actually, on a global basis, that use physical gold in their work, and I found 36. So if you're going into the biggest fight of your life, do you want a penknife that guarantees you're going to lose because this you can only convert into this crap, right? That's zero. Or do you want 36 users or 33 users? That's full functionality and full demand. This is what I want going into this fight. That's it. It's not rocket science. It's it. It's simple.
The official narrative says currency value comes from trust, yet history repeatedly shows trust can disappear far faster than policymakers expect. Lynette Zang's argument suggests the real debate is not gold versus dollars, but intrinsic utility versus confidence-based valuation. The contradiction emerges when governments promote paper stability while central banks themselves continue accumulating hard assets. For long-term wealth preservation, that gap between public messaging and institutional behavior deserves far more attention.